This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Jeff back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jeff's picture saying looking for the downloads. All right, Eric, let's start off with your thoughts on these equity markets.
Patrick, I don't really have a strong directional view here. What I do have is a view that this feels like a good opportunity for buying left tail hedges. So that's what I'm doing.
All right, Eric, well, you adjusting your hedges makes a lot of sense here because to me, the market is asymmetrically skewed against the bulls. We had a 70-day market rally that was almost 1,300 S&P points, 26% on the upside in a short period of time. The market has reached a point of exhaustion. That doesn't necessarily mean that there's a huge immediate downside risk, but as we now approach, as we see on chart number 2 of the S&P 500, the previous high, the risk of resistance along those previous highs is very high. So maybe there's 100 S&P points upside potential if the news pivots that way. But at the same time, we are long overdue for a market correction. Now, does that mean the market correction has to come right here, right now? Well, first off, a typical market correction is about 5%. And so you're talking about close to a 300 S&P point drop. Now, about 150 points lower from here, around the 5,900 area, going into the June 30th is the option strike for the JP Morgan whale, which is a very large fund that has a huge open interest to the tune of $20 billion of notional exposure on S&P call short. Now, the dealers have to hedge this out, which creates a gamma pinning, and therefore it acts like a magnet, drawing markets to gravitate to it. So the idea that this month in June we have a big downdraft doesn't make a lot of sense. But what would certainly be a very natural thing here is for the market to drop 100, 200 S&P points and get sticky around that level going into the month's end. At that stage, the market could snap back in early July, but really at that point, July earnings and other factors like that are going to come into play. That's going to ultimately decide whether we have a third quarter market correction. And so really at this stage, it's more about the markets coming in here and settling down from after such an epic run. And then we'll see later in the month how things are shaping up. All right, let's move on to the dollar here, Eric. What are your thoughts?
Well, we had 3 daily closes below 98 this week. That pretty much confirms that the primary trend is, in fact, down, even though we were just barely above 98 at recording time mid-session on Wednesday. I say the primary trend is and will continue to be lower, but we're also coming due for another counter-trend technical relief rally, so don't be surprised if it's a bumpy ride.
Well, there's no denying that the primary downtrend of the U.S. dollar is still intact. Lower highs, lower lows, every rally immediately fades. So there's no disputing that. But we are also incredibly oversold. And we now tested a very key level of the April lows. So we'll establish something like a double bottom along here. Well, one of the things that makes me believe that it's far more likely to be range bound, where we rally back to May highs and then trade sideways, is the fact that there isn't a broad participation in the currency side. At this stage, the euro did break to a higher high, and the pound sterling's been trending, but the yen has settled in, and a lot of the other currencies are coming to major support lines. And so when we're talking about a broad basket like the dollar index, it's far more likely here that it's going to get chewed up in a trade range than it is to make a big trend move. So right now I'm siding towards support lines holding and just a bounce to the top in the range think it's going to take a lot of time to determine if there's going to be, let's say, a US dollar bull trend. I think it's way too premature to even start speculating on something like that. All right, Eric, let's move on to crude oil. What are you seeing here?
Well, Patrick, what happens next with oil is definitely going to depend almost entirely on how the geopolitical situation unfolds with Iran and Gaza and Ukraine and everything else. Certainly, we're at elevated prices right now, so there's room to come back down if this all settles down, and there's lots of room to go much higher if things really get dicey from here. So we're going to have to watch the news flow to see what happens. My term structure trade is performing beautifully, and I'm pleased to say that I'm getting a tailwind from the way that this geopolitical situation is developing.
Yeah, that's the tricky part here, Eric. Like down along the bottom, when I was looking for that double bottom and the flagging formation for a potential breakout or short squeeze, that was before all of this news came out, and it was a blessing as the oil long came in pretty solid. But really, at this stage, with oil having already moved $10, $12 off that low, we now are sort of in a mid-level where, exactly like you're saying, geopolitical news flow is going to drive the next move, making it a very challenging market to try to place the next trade. So if there's continues to be escalation or the strait shut down, you have a scenario where that could obviously get oil prices up towards those highs of January near $80. At the same time, if things settle down, which it's not really looking like that, a test of $65 in the downside could happen next. I really don't want to make a high conviction call on oil. I loved it a few weeks ago for the setup. It was a great trade at the time. Really hard to make a call on it here. Okay, let's move on and touch on these gold charts.
Well, Patrick, I'm actually delighted that the pace of upside price action has slowed down here. It feels more sustainable to me at the rate we're going now than what it felt like a month ago. As Jeff Curry said, I'm long and I have my seatbelt fastened for whatever comes next. I think there's plenty of room here to go much, much higher on price, but there's also plenty of room for President Trump and Secretary Bessent to throw us another curveball that takes the market down a couple $100 before we move higher. So prices are definitely high here, probably headed higher, and if they go significantly lower, I think it's a buy the dip opportunity.
On page 5, I have that chart of gold, and it's testing major highs. But so far, every dip is being bought, supported along an ascending trend line above all its moving averages, and the rest of precious metal markets are hot. As far as I'm concerned, we have to respect the prevailing trend, and here's the key. A breakout above that overhead resistance of all those previous highs, just below 3,500, opens the window for an immediate breakout. The most immediate upside target is this kind of 3,700 level, but the bigger measured move is all the way up to 3,900. So let's see if that breakout happens, because when something makes a fresh new all-time high like that, it really opens up room for momentum, and the type of momentum we're seeing in these other precious metals market may just spill over. So what am I talking about when saying that? Well, on page 6, I have that silver chart, which is now broken. It's a 6-month trade range where it was putting in its highs near $35. Now that we've broken to 52-week highs, the key whenever you see a break to new highs is, do the bulls hold it? And here we are, like a week later, and the bulls are holding it and even pressing higher highs. This is a legit breakout on silver, and it really now has the window open for moves all the way to $39 or $40 on the upside. And then on page 7, I have that platinum chart, and the platinum has become one of the hottest markets. It went from being dead in a 2-3 year trade range. Here on page 7, I have a weekly chart. So we're zooming out, looking close to a decade here, and you can see this prolonged multi-year consolidation. And with this breakout here on the upside, we have now broken to decade highs. This rip is just nonstop, and the squeeze is well underway. It'll be very interesting to see how much they can build on this, but don't ignore this, because there's lots of room for them to tack a couple hundred more on the upside of this just purely on momentum. But the interesting chart on page 8 is Platium. And Platium has come to life in the last week or two, gaining some traction from the entire precious metals complex, picking up steam. But again, I have a weekly chart here. You can see this vicious 3-year bear market where we saw a 60-70% wipeout of palladium prices, and we're now just seeing it starting to turn up. Is there a new palladium trend starting? It's very premature to already call it a new bull market, but this is how bull markets begin, and this is all of our listeners should be watching closely as to whether or not this is where the action is beginning. All right, Eric, spot uranium prices jumped $5 higher to $75 on Monday, and suddenly everyone's talking about the spot off-market capital raise. What's going on, and why the sudden excitement about uranium?
Well, Patrick, let's start with how SPUT works. It's not an ETF, and it doesn't really operate like a closed-end fund either, because a closed-end fund, unlike an ETF, can trade at either a premium or a discount to its net asset value. Now, the way SPUT works is it's basically a closed-end fund, so it can trade at a discount to its net asset value. It can't really trade at a premium to its net asset value, and the reason is that the fund documents are structured to allow the fund itself to issue new shares as soon as it starts to trade at a premium to its NAV. So that basically created a trading pattern which has emerged over the last few years, where basically the smartest pro traders wait for SPUT to get almost up to NAV, then they short it aggressively. They wait for it to get back down to about a 10 or 12% discount to NAV, and they buy it aggressively. Then they just rinse and repeat that same cycle. So they're long on the way up, they're short on the way down, and they may be delta hedging those positions to eliminate their market risk by taking an equal and opposite position in the spot market if they're physical traders. So there's lots going on that's kind of manipulated this and frustrated so many people. Almost everybody that I've talked to who's very knowledgeable about trading and who really understands this market is saying the same thing, which is we've got the spot price, which is really determined only by very thin trading. It's not really the primary market, but the spot price has fallen substantially below the term price, and that's the reason this market has been stuck and broken. We got to do something to get spot back above the term price in order to get the market to really take off. Well, if we've got all the smart pro traders, every time spot gets almost back up to trading at no discount to its NAV, well, that's the moment when it's really important that we allow it to trade up to its NAV, because it's when SPUT's trading at its NAV that it can start stacking more pounds of uranium. The way that they issue new shares is that they use those new shares to buy physical uranium on the physical spot market, and then they keep it. They don't sell it again. They just stack it and hang on to it. So in order to get SPUT back into the mode where it was a couple of years ago, where it was buying, and it was actually the speculative interest among traders buying SPUT in turn buys physical metal, that pushes the spot price higher, that gets more excitement going, the market continues to feed on itself, and it moves higher and higher. We got into this crazy trading environment where the spot price is broken below the term price just because it's a thinly traded market and because sentiment's in the wrong place. How do we get back to where we need to be? What are we going to do to get back? Well, it seems that a bunch of really responsible and ethical traders noticed this problem and said to the operators of the SPUT Trust, that's Sprott, look, guys, we'd be happy to consider participating in a direct private placement, not at a discount, which is the usual way that private placements entice investors into the market, but at NAV. Why would we do that when we've had the opportunity in the last couple of months to buy at a discount to the NAV, and we know we probably will in the future? Because we want to see SPUT actually buying physical in the market, not just trading up and down and changing its discount level, but actually buying more physical uranium in the market. That seems to be the motivation for this, and I'm going to suggest that retail investors listening kind of take a buy SPUT for the team campaign under advisement. Obviously, what's better for you is to wait till SPUT's trading at a discount when you buy it. You had an opportunity 2 months ago to buy it at a 15% discount. But if you buy it at a discount, it's not going to do anything to help move the spot price back to where it needs to be to really help this market take off. So for investors who are able to, and I'm doing this myself, I recommend that you consider, if you're adding to your uranium positions as we get a little pullback here, do it by buying SPUT. That's U.U or U.UN are the ticker symbols, depending on whether you want to pay in US dollars or Canadian dollars. By buying at the market while we're trading up here at NAV, your buying is going to allow SPUT to buy more physical uranium, and I contend that's going to help to really get this market moving. I think that's the reason they did this capital raise, and I think that we could help it by adding some buying support, not only institutional investors who have already pre-subscribed to Canaccord's bought deal financing, but anybody else who's buying on the screens. If you choose to buy SPUT rather than one of the other uranium shares while we're at this critical moment in the market, it's going to help everyone else. So that's the do-gooder PSA for this week's episode.
The trend really has turned around. We've seen a prolonged 15-month bear market in uranium prices that have gotten it basing out back in April. And now we're finally seeing price action that is legitimately demonstrating a potential new bull trend getting underway. At this stage, we've been waiting for the actual uranium spot prices to finally start participating. And it really could be the beginning of that right here, right now.
Patrick, before we wrap this week's episode, let's hit that 10-year Treasury note chart.
Yeah, finally, I want to just touch on those 10-year U.S. government Treasury yields. And here in the post-FOMC, we have the 10-year Treasury yield relatively unchanged and flat in a very tight trade range. We really have seen the long bond and the 10-year really consolidate into a trade range. It'll be very interesting to see what the next big move is. But right now, this tight range is consolidating and is not showing its hand. I'll be looking for a breakout above those yields of 460 if we see some sort of bond stress. But at this stage, it's not a given. Though moving on, what is interesting is on page 11, I have that 3-month Sulfur futures going out to the December 2026 contract. Now, this is looking at the Fed path essentially for the next 18 months. And currently, they're pricing in 3.25% interest rates in going out 18 months. The thing is here that the Fed is in a situation where they continue to stubbornly keep interest rates unchanged. It's certainly creating stresses with Trump. And the question becomes, is there going to be some pressure or is something going to break that is going to force the Fed to pivot more dovishly and force this chart to start pricing in an extra 50 or 100 basis points of cuts that the market currently isn't got in there? This continues to be an interesting trade setup, and I think it's one that I'm going to continue to focus on in the weeks and months to come.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly research roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.